Hi, welcome to this live webinar. Today we're looking at property rental tax in the UK for people that are living and working abroad. So we're addressing this as an issue for expats who own UK property rental, and we're addressing it from the perspective of UK expats who are living and working abroad and still got property back in the UK. Now, this covers quite a lot of circumstances and quite a lot of different criteria. So we want to have a look at those and consider what the options are, because today we've got a new tax year. So we're into the new UK tax year, and tax returns for calendar year countries like Cyprus are now available and due to do in April. So it's the new tax year now. We're into April and we need to be getting on with doing our tax returns for the last year, be that to the end of December 21 or be that to the 5th of April 22. So how are we going to do that? We're going to consider it today from a global perspective, property rental income, and then look at it as from a UK perspective of that income before we give an example, and we'll use the example again of Cyprus property rental income just to illustrate the complexity of that, and also how that feeds back into an English return if a UK resident owns overseas property rental income. Because what we need to consider there is that is this property rental income, is it being reported, and should I be declaring it? This is maybe something that expats haven't done in the past and that they need to consider doing going forward. So let's have a look at that. From a global perspective, all property agents report what's happening. And, with the recent events of 2022, this is ratcheting up another level in terms of identity verification and anti-money laundering. Anti-money laundering legislation might be targeted at criminals, might be targeted at terrorists, but tax is a criminal legislation, and if you don't declare your income properly, it's a criminal offence. So all taxable income comes under anti-money laundering regulations. So whether you're with a bank or an investment company, you've been used over the years to providing ID verification and address verification. But this has ratcheted up last year and again this year, so that any property agent now, investment company, bank, accountant, tax preparation service, or lawyer needs to be able to show to you as a regulated business, or to show to the regulators that they've got photo ID for you, either your national ID if you're in the EU or the States, or your passport would do, or driving license would do. So a photo ID is one requirement. Address verification with a utility bill or a bank statement is a second verification. They'll accept a bank statement confirming the address because that is verified against your utility bill. The bank have done that verification as well. If there's a company, they need to prove who the beneficial owners are. So if you've got a family trust or a family company and you've got a number of different beneficiaries, each of those beneficiaries needs to verify their own identity, so that you've got that proof of funds in the regime. And then at the next level after that, you also need to prove source of funds. So if you have got a big flow of money to buy a property, for example, you need to show where that money is coming from. Now, this makes buying property or selling property, very complicated for some people and can cause confusion and delay. But have in mind that once that information is sought and registered by your rental agent or the estate agent selling property or the bank doing the mortgage, that information is shared with the tax office. So an expat living and working abroad could be resident in Switzerland or China and investing in property in the UK. Even if the expat is resident in another jurisdiction, they will exchange the information from the property rental income in the UK will be exchanged back to their country of residence and vice versa. So for a UK tax resident who's investing in overseas property, they might not have declared the property rental in the past, but that information is shared now, and that will come back to the tax authorities to either auto-fill the tax return or to verify against the information that you submit. So when you look at a tax return in the UK or in a jurisdiction like Cyprus, the tax return that you submit is verified against the exchanged information they've received from another jurisdiction. So it's very important that you be aware of this and that you complete a correct and full information of all your registered income. And that would go for an Airbnb as much as it would go for a private holiday let or a long-term let in the UK. So that's the conditions. Now, property rental, as we were saying in this series about New Year tax years, property rental income in the UK has changed quite a lot over the last few years. One thing that hasn't changed is that property rental income arises in the UK, therefore it's taxable in the UK. So if an expat has got £1,000 allowance, so if your rent is very, very small, then you do have a personal allowance. Once your rental income goes over 1,000, you have to report that income to the HMRC in the UK. So whether you're owning property from abroad or whether you're in the property's in the UK already, it's being rented out. If it's your rental income is more than 1,000, it needs reporting to the HMRC, and then a return needs to be done. Whether you've got gross income or net income, in effect, any net income is automatically reportable on a tax return over 2,500 a year. So more than 200 a month rent is reportable in the UK, whether you're owning that property from overseas or whether you're in the UK and own overseas property would be the same, because it's still classed as property rental income. So because property rental income is reported under self-assessment in the UK, then like self-employed people for the UK, it's all deemed to be earned on the last day of the tax year, the 5th of April. So you've got some flexibility there. If you're renting through a registered property agent, they can deduct tax at source. A non-resident landlord, so an expat who's living and working abroad, can register their property, can register as a non-registered landlord, but again, you're verifying that you are overseas. You're verifying that you're not where your tax resident is, and that it's shared with the UK and the property rental income. So your source income and your destination income are both reported on one lot of tax returns. So it's an important point to bear in mind there. So that non-resident landlord allows you to get income gross in the UK, but you must report that then in your country of residence. Vis-a-vis, if you're in the UK and you're renting property in Portugal or Spain or Greece or Cyprus, that income is reportable in the UK on your income as foreign income or as property rental income, depending on how you're treating it as an individual or as a business. So if you need help registering as a non-resident landlord, contact us at proactpartnership.com. Go to our website and we can give you help and guidance on getting that registration return done. We've got a retained client service where you can register and get online advice and guidance for, is this allowable, is that allowable, how do I complete this section of the tax return? Or if you want us to do the whole service for you, we can do that as well. So jump on board and get registered with ProAct. And while we're talking of our services, and you're watching this on YouTube, if you like it, please do leave a like, leave a comment, and share it. And don't forget to subscribe, so we'll keep you up to date with later returns and later webinars as we develop this New Year tax series and our other series for expats living and working abroad, relocating overseas or investing offshore. So if you're a non-resident landlord, you can have your income in the UK paid gross, but you've still got to pay tax on that. You've got a personal allowance if it's a very small income a year, but otherwise, the good news for expats is if you've got no other income in the UK, you can use your personal allowance of, using round figures, 12,500 for that year. But above that, then 20% tax does become due. And this is where a lot of complication arises with property rental in the UK. So if you're got this as a personally owned property, there's a limitation on what you can charge as an allowance against your income. So you're not allowed to offset mortgage interest, for example, on a UK private rent. You can if you incorporate. So if you buy the property through a company or operate or transfer it into a company, that can be done. But switching between the two forms of ownership is a full conveyance. So you have stamp duties, conveyance fees, and potentially capital gains assessments on a transfer between an individual and a company. Doesn't mean that it's not cost effective. And when we do a tax preparation for a client, we look at that. It might be become more cost effective to go and make their property rental a corporate arrangement rather than a personal arrangement. And there could be potential long-term capital gains tax savings or income tax savings, because for an individual personally owned property portfolio in the UK being rented out is subject to income tax in the UK. So potentially you've got a liability up to 45% if your property rental income goes over 150,000, whereas in a corporate structure, the income is limited in the UK to a UK company's corporate tax is 19%. So the self-assessment return assesses all the income as if it arises at the end of the year, 5th of April. So on the 6th of April, we're doing a return based upon last year's income with last year's allowances and expenses to offset against that. If you made a loss, you can carry it forward. If what you can claim as expenses, it varies. So if even as an individual, you could be a commercial property agent, in which case you can get some allowances and capital allowances, furnitures, fixtures, fittings, wear and tear can be offset against that. And obviously that can be an advantage if they're legitimately spent. So again, that's part of the tax preparation service. We can help you with either with our online retained client service or with our ProAct tax preparation service that's available to our clients. Contact us at proactpartnership.com for more help and guidance on that. You could also, in the UK, pay national insurance on your property rental income. So if you're running it as a business, even as an individual, you could have a liability to a national insurance. Now, there's been some big changes announced going forward, as opposed to going back. So the tax return we do in April 22 is for the last year. So it's used on the last year's thresholds. Going forward, national insurance allowance is changed. Although it's announced in the budget to take effect in the current tax year, it doesn't actually come into effect until the beginning of July. It's the 3-month switchover period to make those adjustments. But essentially, the personal allowance for tax and national insurance is equalised at around £12,500. So you can earn £12,500 of property rental income without net of reasonable expenses, without a national insurance or an income tax liability in the UK going forward. So that's a very tax efficient investment for expats. So if it's a UK expat and you leave your property in the UK and you rent it out, it becomes very it's a tax efficient way to generate some extra income. The movable incomes you have, your pensions, your dividends, your bank interest, or your earnings overseas, they can travel to your new tax residence. So it allows you to use 2 personal allowances in 2 jurisdictions to your maximum effect. So consider that and let us know if we can help at proactpartnership.com. You have to do the return. It's your responsibility to make that notification. UK returns are due from the beginning of April, and they're due. You've still got the option to send a manual one or an online return that will be due by the end of January in the following year. The paper return has to be submitted within 6 months. In a jurisdiction like Cyprus, you don't have that option. It's all the returns must be done online. And bear in mind that all the information that you're reporting on your tax return is verified with exchange of information. So it doesn't matter, your bank is reporting the income flows and capital flows through there, as is your investment, as is your property agent, and technically your lawyer and your accountant as well. So they're all reporting to the tax authorities. So have those in mind and make sure that you make the return correct and it's verifiable against the exchange of information. Exchange of information runs for all countries around all the world. So it could be that you can't rent property overseas and take it as a tax-free income in the way that people might have thought they could do with their Spanish villa in the past. It has to be reported. If you don't make the report, it will be found out at some point, and that will be a complication. Whether you're selling the villa in Spain or Cyprus, or whether you've got an inheritance tax return or a capital gains tax return or a business entity in the UK. So just have in mind for that. So let's just focus a bit more on overseas. The way the UK report and manage property rental income, it can be a very tax efficient investment for an expat living outside the UK to have an additional tax-free income, maximise the personal allowance. Doesn't mean that it's not reportable on their tax return where they are tax resident as well. So it may lead to additional income there. But it's tax efficient income in terms of not paying 20% income tax in the UK. If we look at Cyprus as a comparison, again, Cyprus tax returns are now available to do for the previous year from April. So those opportunities exist. Now, property is taxed as a separate class of taxes completely. So if you think about it, if you look at your UK tax return, you've got your basic income statement, and then you have the addendums for employed income, self-employed income, foreign income, you can have property income and your non-resident status, and capital gains tax returns. So anybody has to add those in. So if you sold a property in the last year, you have to add that capital gains tax return or that income tax return. All those things have to be added in and into the return. Now, those old schedules were called A, B, C, D, E, F, G of tax. And that was just to keep the separate areas of income private and discrete when tax returns were first introduced around about 300 years ago. In other jurisdictions like Cyprus, different types of income are taxed in completely different ways. So they have some income which is progressive in terms of a personal allowance at 20%, and then a higher rate up to 35% in Cyprus on income. But there are some flat rate taxes as well. So in Cyprus, pension income is flat. Expat pensions are flat rate 5%. Interest is flat rate 30%. The dividends are flat rate 17% without the personal allowance. So it doesn't work in quite the same way as another jurisdiction. So to maximise your allowances, you need to consider what the options are. For an expat living in Cyprus as a tax resident with a non-domicile status, they don't get any tax at all on non-domiciled income, such as dividends or interest, and they can get some relief on property rental income as well. However, if you own and rent property in Cyprus and you're a Cyprus tax resident, you've got an income tax liability and a flat rate 3% tax liability. There's an allowance, so effectively the tax rate is 2.25% as a flat rate on property rental income, whatever the level. Now, if you're non-domicile, you don't pay that tax. But so an expat investing in Cyprus property doesn't pay that 3%, but they still have the £17,500 approximately personal allowance before they pay any income tax at 20%. So investing in Cyprus property can be very tax efficient from a Cyprus perspective if it's your only source of income. But for an expat in Cyprus, a property investment can be a very tax efficient form of income if they have no other relevant income. If, for example, they're paying 5% on property rental income, or they've just got dividend income coming through from an overseas company, and there's a non-dom paying 0% tax. So the property rental income tax source, you can't offset all your individual allowances. There's a deemed 20% expense on a Cyprus property rental, so it's a flat rental, but you have to then pay in addition a health tax at 2.6%. Again, it's a flat rate on that property rental income, and VAT. Now, in the UK, VAT for a property rental business won't kick in until turnover exceeds £85,000. In Cyprus, the VAT threshold for registering is the lowest allowed by the EU at around about €15,500, which is about sort of £13,000 a year. So above that, it has to be registered for VAT, potentially. There are some exemptions, but again, it's another factor, another consideration. Bearing in mind, we've got exchange of information between agents, between banks, between the people and with the loans, or the people with the equity stakes. So consider that reporting and that liability. So what I'm trying to illustrate is that property rental, especially holiday lets or overseas property rentals or income registered in property back home in the past, wasn't always reported, and it was a bit of a cash in hand business. That's gradually got more and more regulated, and that regulation, exchange of information, to know beneficiaries, to know to do a tax return. For example, Cyprus have allowed property trusts, family trusts for many years, but the extra compliance in Cyprus now is that they have to do a tax return each year as well. So have that in mind. So that's reporting of the income to make sure that there isn't additional tax that's due in your country. A double taxation treaty stops income being taxed twice, but you still may pay a highest marginal rate. In Cyprus, they have exemptions for non-domiciled expats. In the UK, that's not necessarily the case. So someone's expat to the UK, they're only liable for their fixed income in the UK, which could be their property rental income, and that's their sole income. All their other pension, investment and dividend income is movable, and it's moved with them overseas. But in other jurisdictions like Cyprus, property rental income can be fixed. There can be a non-domicile exemption, but there may not be, and those taxes need to be paid as well and considered in full. That level of complication and that level of advice and guidance we can offer you through our proactive retained client service. Go along to our website at proactpartnership.com, chat with us live, and that opens up the ability to register as a retained client at proactpartnership.co.uk. You can subscribe and get that advice and free consultations with our consultants to help you and guide you on your property rental investment or business, depending on how that's working for you. Tax returns are due now. So April is the start of the tax year. It's the start of the spring. It's the start of the old Julius Caesar, Julius calendar, new year. So there's tax returns are due now in many jurisdictions, including Cyprus and the UK. So we're now collecting information from clients to get those returns done as soon as possible. If you found this interesting, please subscribe. Watch us again next time. I've got some very, very interesting webinars coming up in the coming months. But first and foremost, get set to collect the information from the last year, share it with your tax agent, and we can help you with that so that we can get that prepared and get those returns started so that you get the tax returns submitted by the deadlines. Deadlines for returns this year from the middle of the year onwards, but we need time to get that work prepared. And now is the time to spring clean, get the income to us, and let us complete those returns for you. So thanks for listening. Subscribe to our YouTube channel, Proact Partnership, Living and Working Abroad. Share it with friends, like it, comment. I've got some comments now. For our retained clients, we now switch over to a Q&A session on Facebook, the Facebook group, which you know all about if you're a subscribed client. Thanks very much for listening, and we'll see you again next time. Oops. Bye.